All right, and live from YouTube, the Tech.mn YouTube channel, for the very first time is your host, Kevin McArdle.
Hello, Jack Stark. I am nervous with this very first time of the YouTubing. I'm not generally the broadcast my life live type of person.
Yeah, it's our first time. Bear with us, but luckily we have a pretty easy guest today.
Guest, friend of the firm?
Yes, we have Reed Robinson. He is the brand new founder of Groove Capital. Welcome, Reed.
Thanks, Jack and Kevin. It's great to be back in the studio with you guys.
The virtual studio. Good to have you back. So we got old faces in new places. Last time you were on, it was about a year ago, leading into Twin Cities Startup Week, because you were the director of Beta and Twin Cities Startup Week. We're leading into a new Twin Cities Startup Week, and either right before or right after this podcast, Casey Schultz, we've already recorded. She's talking about all the amazing things coming with Startup Week, virtual mostly this year.
Startup month, actually.
Yeah, Startup month, all of September. Can't fit into a week anymore. So why don't you get everybody caught up on kind of what has happened with you, your role. You're still involved with Beta, but in a different role, and before we get into Groove.
Yeah, absolutely. So I think it was last November-ish. It was after Startup Week that I had announced that I'd be stepping down from the day-to-day management of Beta, and that was really all part of the plan from me coming in the first place, was find the next leadership group and build a team around that individual and kind of work my way back out of the day-to-day in Beta and move back into the board. And so working with Casey last year, that was a big part of that process, and kind of getting her battle tested with running a Startup Week last year, which she did phenomenally, was really encouraging and gave us the information that we needed to know that we had found the leadership that we were looking for. And so we made that transition at the beginning of this year. Casey and I ended up kind of running co-pilot through the first quarter, just to make sure that she had the support that she needed to be successful. And when we got to a point where that was in a good place, I stepped down. And so that was sometime in about mid-April that I was no longer involved in the day-to-day, and have since been supporting the organization kind of back in the board capacity. So it's good to be out of the weeds. But by no means am I disconnected from the organization. I'm still very passionate about who we are and what we do, and wanted to be successful, and trusting Casey and the rest of the team to continue that mission.
Yeah, and Casey did a good job of explaining kind of shifts in the board and how Startup Week is going. So we don't need to recover that ground. But I'm curious, as I recall, so you were one of the founders of Beta, which inherently makes you a founder of Twin Cities Startup Week. You came into the director role. Is it managing director, or what's the title?
I think I called myself executive director. It doesn't really matter.
Yeah, so you kind of went into the day-to-day operations, but it was always assumed to be like not forever. Am I remembering that right?
Yeah, I don't know if that was like the way that was publicly shared, but my intention has never been to be the executive director of a nonprofit. I'm an entrepreneur, and we got to a point where the organization had grown to a place that it needed some additional attention. Nels Pedersen, who's now at Livefront, was the person that was kind of running the day-to-day before I joined. And so when he was moving on, I came in with the intention to kind of stabilize things, help it grow, build in some systems and some operation, and kind of get it ready for its next life and new leadership team. So whether or not that was the public perception, that's kind of always been my plan and our plan behind the scenes. And so, the plan played out in a way that was successful, and I think we're happy with the outcome. The organization's in a good place, and really excited about all of the things that have really kind of taken the next step. Specifically, has been thinking about it. The cohort especially has really evolved into what's now probably more a traditional accelerator. But the intentionality around the education components, and what do founders come in with and what do they come out with is totally different than what it was before, and I'm really excited about what that can mean for particularly first-time founders who have never gone through this experience before. So a lot of things to be proud of, but just the best part about beta and any of this kind of community development work is you get a chance to work with really great people who are trying to do amazing things with their businesses, and creating resources to help them is rewarding work. And it always has been and always will be.
Yeah. So still on the board, still involved, but got a great team running the day-to-day. So when did you start thinking about your next move, which eventually becomes what we'll talk about as Groove Capital? But talk me through the thought process and the evolution of the idea and the timing, especially because you had to be all in with beta and startup week. But as Casey was coming in, when did you start hatching the ideas that became Groove?
Yeah, I don't know the exact date, but I guess it's somewhere in the like 2 to 3 years ago range. We wised up within beta and started asking the founders that we had been working with, to share their information with us as far as their continued development, and in the form of data that looked like, how much funding have you raised since you went through our programming? What's your kind of current head count? And so we had started to see a lot of information that was reinforcing the thoughts that we all had, that the companies that we had worked with that were growing. And then after a while, those numbers you couldn't really ignore anymore. Beta companies, as of December of last year, had raised over 350 million and had produced over 1,200 jobs. And so when I started looking at those numbers along the way, it was like, dang, like this is fantastic, and hopefully, exciting and energizing data that the community can look to and celebrate. But the entrepreneur in me is like, I wish we would have had a fund, right? Because this probably would have been a pretty effective.
Invest a little bit into that, yeah.
Probably would have been a pretty effective fund, and we were seeing a lot of great companies, and we were really early in those companies' lifetimes. So I think again, the entrepreneur in me saw that there might be another way to create some value here, and so we had a conversation within the beta team of does it make sense for us to have a fund in addition to the other programming? And with a couple conversations around mission and alignment, and the beta is a 501c3, so there's some structural issues, but ultimately it kind of came down to those organizations exist to educate and inspire, and from a mission perspective, it didn't really make a lot of sense to add an adjacent investment vehicle for that, because it just blurred some of those lines. So we put it on the shelf and didn't pursue it, and that interest kind of festered within me, and so as we felt like the leadership kind of was coming together, and I was starting to see that there was an opportunity for me to move out of the day-to-day and focus on something else. This really took my attention, and so when I left, the first thing that I did was start investigating the hypothesis that ultimately led to the thesis of Groove, in pulling together the data and the plan that I'm now kind of looking at is what the ultimate goal is of this new entity. So that's the backstory. And you know, I think the fun parts in there is like, we've got a lot of great information and a lot of great companies that are growing, and I think we all see it. And I'm convinced that we're just scratching the surface. So
yeah. So
quick question. Was there a defining moment when you were like, okay, I have this hypothesis and I'm actually going to go for it?
Yeah, it's easy to have a hypothesis, but to start a business is a different deal.
Well, I mean, on the data side of things, like Sezzle IPOing was you know, from a impact perspective, you know, that definitely sets off a lot of alarms of like, these are the ultimate milestones that you want to see these companies achieve from an investment perspective. So those indications help. But honestly, Jack, what happens in these things, this is my experience, is like, you start talking to a couple people and you start bouncing the idea off of it. It's not necessarily something that you're pursuing until you realize you've said too much and you've put yourself out there too much. Like at some point you just can't turn back. It's like this thing, I mean, I've you know, I've talked about this thing way too much. If I don't do this, like I've lost all credibility. And so I do remember, I don't know when it was, but sometime in the spring where I was just like, I think I've already signed myself up to this, not having even thought about that like along the way. And so,
Totally.
you know, it was just got to a point where it was, okay, I guess I'm doing this, and you know, and my enthusiasm has only continued to build for it. So
if people want to go deep on the background and the hypothesis, as you put it, you've just published like a 4-part series on tech.mn called Mind the Gap. So we'll link to that in the show notes. But give people like the Cliff's Notes version of why did you call it Mind the Gap? Because that's important. Like what is, you know, most good businesses, every good business solves a problem. So what is the problem that you've identified that you are now trying to solve via Groove, or problems?
Yeah, you know, Mind the Gap, my intention with that was really to add some definitions around words that are thrown out there in the startup community that have a lot of confusion around them. And, you know, for example, what is early stage? It depends on who you ask. Every person's going to have a different definition of what early stage is. So when you hear entrepreneurs say, you know, there are no early stage investors, or you hear investors say there are no good early stage deals, like I've been hearing that since I was a founder back in 2012, those comments. And so
yeah, Beta has just Beta alone has touched, I think you told me before we recorded, like 162 companies. Is that the right number that's come through cohorts?
Yeah, after the last cohort that just graduated this spring, that number is 162, and I think we're just about to start making decisions on the next one. So there'll be another, you know, 12 to 14 companies on top of that. It's about
so
25 companies here.
162 quote unquote early stage companies, because you only take early companies in Beta, that have gone on to raise $350 million. That's just the companies that Beta has touched. And there are a number of other accelerators, many of whom we've talked about on the podcast. So it's just clear evidence that there are early stage companies that need and get funding, and there are investors somewhere who are funding these companies. But there is this sort of like weird confusion that it doesn't exist. And it's not just confusion. There is a reality that there is a gap in the capital ecosystem, right?
Yeah. And you know, again, so my point in creating that series was just to give us all some common language for us to like truly understand what is the issue that seems to be unique to this entrepreneurial ecosystem. And you know, the conclusion was, every startup community is going to complain about a lack of capital. That's just what entrepreneurs do. In every market, there's somebody that's going to say that. We do actually have a very critical gap in the capital structure. And from what I've researched and learned, it comes down to two specific situations. The first being there are no institutional investment funds, so like VC groups that are regularly investing in the pre-seed market in companies in Minnesota. There are
pause there, because regular listeners to the podcast will be like, well, what about Matchstick? Ryan Brochard's been on the podcast and is one of your co-founders of Beta. What about Brett Brohl? What about Rob and Ryan Weber with Great North Labs? Like Rob's been on the podcast, and Capita 3, and there are a number of VCs based here.
Yep.
Bread and Butter just announced Mary Grove and Brett Brohl. What are you describing that they don't? What's the need that they actually don't meet? Because people know them, but they're not solving the problem that you've identified. And why?
Yeah, and I would say they are, but it's the exception and not their standard operating procedure. So Ryan with Matchstick, Brett now with Bread and Butter, the Webers with Great North Labs, all of them have made pre-seed investments. But looking at the sheer volume of those investments over the last few years, you can count those on maybe two hands or 10 fingers and 10 toes. So when you look at the volume of startups that are coming from the ecosystem and the number of investments that are being made in Minnesota at that stage, there's a very big delta between those two numbers. So those companies and all of them have been more active at this earlier stage, but in each one of those cases, they've raised larger funds, which is amazing because as a community, we have access to more capital through those organizations now. But that changes the dynamic of what their models are that look for them. They have to write larger checks because they have larger investment pools. So by nature of them raising bigger funds, they kind of shift into later stage investments. And so if they're shifting into larger later stage investments, the criteria that they're going to apply to their investments is going to change. And that's when you start getting, you start spreading out the difference between where companies are at today and where they need to be in order to get investments. So again, there's tons of exceptions to this rule, and we actually do have a vibrant venture community. It's just we're concentrating a lot of the capital around a very specific investment stage, which is the seed stage.
Which is later than what you're focused on.
That's right.
Groove is focused on first checks, and that's what I like we've discussed. That is, forget the noise about, we've had people kind of roll their eyes at like, is this a pre-seed or a seed or bridge, post-seed, or these crazy terms that don't really mean anything depending on who the audience is. But if you just say first checks, it's very simple. That means the first money into a company is where you're focused. And just to put a finer point on it, we'll use a hypothetical, first fund from the VC is like $3 million. You can write 30 $100,000 checks to deploy that money over a period of a few years, and that makes sense. If that same fund raises a second fund that is $30 million, it is no longer reasonable to write $100,000 checks, because you have to write 300 of those to deploy it over a number of years, and your investors want you to deploy it quickly with good companies. So you have to start writing bigger checks. And if your check size has to be 300,000 or higher, all of a sudden it doesn't make sense to give that money to a company who just needs a couple $100,000. So there is VC math at play here, where naturally, and it should be said that not only is it good for ecosystem if this hypothetical fund raises $30 million, because that's more money into the system. That's actually more money for the GP in charge of the fund. So they get paid a percentage of assets that they're deploying, and they get carry on when the money starts coming back. So there is natural incentive for anybody in VC to try to keep raising bigger and bigger funds, which creates this constant vacuum in the early stage. Did I summarize that?
Yeah, I think that's accurate. I think the other differentiation is the focus, and I want to be incredibly intentional about prioritizing founders in Minnesota, and for the pretty much every seed group in town, that's not the thesis. The thesis is global as far as who they're looking to serve, which is good because there are great deals outside of the state. But as I continue to experience the issues that we're struggling here within the state, for me, it was important to come in with a solution that's just, we're only going to invest in Minnesota. And I'm hoping that with this solution, I can help the deal flow that can ultimately lead into some of these other organizations, make investments in companies that are in the pre-seed stage, move them along faster through that development cycle so that they can get the data that they need in order to get the seed stage investment from the rest of the community. So for me, it's like laser focused on a very specific stage, a very specific geography, and that it's also the area that I know best. So that's issue number one. Issue number two is, okay, so if we don't have the institutional funds at this stage, another common element to support startups at the stages are angels. And so angel investors. And so there's a whole piece that I laid out of like, what is an angel and where do they make investments and how do they get involved and what happens to angels at different stages in the deal. So that's all in that Mind the Gap piece. But the most important point in that article was this research that I did into the angel tax credit. And the reason that I did that is because I wanted to try to add some numbers behind, like, okay, we've talked about the angel community here before, and where are they? They're hard to find. There's like a dozen or so names that if you're in this group, like in this community, and so you get introduced to people like Joy Lindsay or Darren Cotter or Lisa Crump at some point in your life, and they're amazing people, but what we're asking them to do is too much.
And you kind of jumped over, if you're in the right community, you get introduced to these people, but and I don't know all of those people well, but even a good, generous person who wants to make angel investments can't just meet every founder in the world and pitch. And there are we've had a number of founders on the podcast that either while recording or after recording will say, who are these angels that I keep hearing about? It's like this mythical creature that, I'm not in the club, so I don't know how to get in front of these people.
Yeah.
And unfortunately, a disproportionate number of the founders that I hear frustrated about the funding landscape are women and people of color. So that's a problem.
Yep.
And I'm setting, the angel investors you've mentioned, I don't know their investment history. I'm not calling them out at all for their proportion of investments. I'm just saying it is a reality that the stories I hear and the data show that women and people of color are disproportionately underinvested and underestimated. And so, you and I both sort of just came upon this problem from different angles, but same thing, right? Like investors, I'm, I don't know, privilege is not the right word. I happen to bump into people who want to invest in companies. And I am privileged to know a whole lot of founders who are trying to build great companies, and they both complain that the other group doesn't exist. And I'm like, this doesn't make any sense. So, talk about the angel tax credit research and what you found digging, what is the angel tax credit for those not familiar? Let's start there, and then how did you uncover this?
Yeah, sure. So the angel tax credit, I think the first year was in 2010. It's a program run by the state of Minnesota. It creates an incentive for high net worth individuals, accredited investors, that gives them a portion of their investment back in the form of a tax credit.
So let's pause to define some sort of high net worth individual to qualify, or it's an accredited investor to qualify. If I remember right, you have to have $1 million in net worth, with home is included in that if you have equity in your home, and or make 200K as an individual.
Yeah, or 300 as a family.
Okay, so that is a lot of money by any measure. And there are a lot of people that qualify for, you say high net worth individual, I think people picture like Richard Branson. The bar is actually much lower than people realize.
Yeah.
Yeah.
So that's where it's starting from of who qualifies for that program. And so the process is you get certified with the state by telling them, yes, I meet these qualifications. And then once you're certified, you make investments, and then you have the opportunity to get the credit. So we've had this program for the most part every year since 2010. I think there may be 1 or 2 years that it hasn't existed. And 2020 is actually one of those years. So we're in a gap year that hopefully will clear itself up. But in any case, this is all public information that the state produces, so anybody can do this research. But what I did was I looked back, and what they publish is the who got certified. So it's not who made investments, it's who got certified. But what I've gathered from interfacing with the people at the Department of Economic Development is about 90% of people who certify end up making investments. So it's pretty much most of them. But anyways, you get these names every year of people who certified, and then I just crunched the data and said, okay, how many people have gone through this program? And that was a little over 3,400 people, unique individuals.
That have gotten certified and likely made an investment. Let's just call those one and the same for the sake of discussion.
Sure. Yeah, we'll call it, let's say it's 3,000 people that have eventually made an investment. So that's one. And the reason that I started looking at year to year, because I wasn't interested in the names. I was actually interested in who was actually doing it more than once. Because there are a lot of people who get brought into investment deals. And I think my hypothesis is it's a lot of like friends and family who are like, hey, I want to support so-and-so. I heard about this program. I'm willing to write a check for 50,000 or whatever it might be, and help them launch their food truck, as an example. And that's amazing. Those people, are considered angel investors, but if they only do it once, it doesn't really make a meaningful impact in the community, right? It helps that one individual, and that's amazing. But what I found by running the numbers was only 25% of the people certified got certified more than once. So that means 75% of those 3,000 people never did the program again. And so, off the bat, it was like, okay, we had way more than I was expecting to be in that program, which is the good news. Bad news is they only do it once. And so, like, if we're looking at this as a SaaS model, this is your churn, and your churn for that program, it's pretty bad. And there's probably a lot of different reasons that exist, but as ecosystem builder Reed looks at this, it's like, that's an issue that needs to get solved, because we're not keeping these people engaged in this program. And so I came up with a definition of, all right, well, let's say active investors are people who have done this at least every other year. So who's on this list five or more times? And when I broke down to that number, that's how I got that number 52. So 52 people have meet that qualifications, mean they hit that list 5 or more times. 52 people are, consistently in the ecosystem, writing angel investment checks and in the state of Minnesota. So I'm not saying that that's all of them. I think the tax credit is a good incentive that's going to draw most of the activity, but let's either double, triple, or heck, we can quadruple that number. And let's say there's 100 to 200 angels. That's not enough. And so working with the state, I kind of backed into, looking at the demographic and income numbers to try to figure out, okay, well, what is the total addressable market of angels in Minnesota? And I came up with a number. And then I actually got the number that the state had done itself, which is also public information. They came back with about 40,000 people within the state of Minnesota who would meet those qualifications of accredited investors. So
40,000 people have the net worth or the income to make investments.
Yep.
And only 3,000 ever have. And
Yeah.
only 52 of the 40,000 have done it on a repeat basis.
Yeah, so the difference between, let's call it 150 and 40,000 is a pretty massive delta, right? So for me,
it's just over 1% of the eligible investors are making angel investments for those keeping score at home.
Yeah, and it's like as I'm looking at that, it's if there's one thing that I think that could drastically change the momentum of this community, it's how do we get more people involved? We have capital, we have these amazing companies, people who are well-to-do, have incredible expertise available, and so the question is, why are they not doing it? And I think the common answer is, we just don't have the risk profile or the tolerance to get involved in angel investing. And quite frankly, I think that's bullshit.
I think it's kind of a lazy answer that just sort of grabs onto like, oh, Minnesota culture is conservative, so therefore drawing 100 conclusions that don't really necessarily back up these numbers.
It's not true. If I have to put it at one thing that's leading to them not investing, it's because they don't know it's an option. Mm-hmm. It's an awareness issue. People invest in the things that they've made money in themselves because they know it and they understand it. And so if they've never made their wealth in a startup or by working with startups, they're unlikely to have invested in it at some point in their life. So it's on Groove now, and it's on, I think, this community to try to introduce more people to this concept. And so you do that by helping to explain the situation. That's part of what the Mind the Gap thing was. But going forward, it's how do we get in front of these groups and explain to them, these are the types of companies that we're producing. These are the types of investments that can be made. Here are the risks involved in angel investing, and here are some best practices of how to build a portfolio if you're going to be making your own independent angel investments. And that's what I really want a big part of this group to be known for and responsible for, is providing education to people and activating those angels and bringing that number up to a place that seems to be in line with the demand.
Have you found any research of other states that are doing something comparable, or how their angel investing is?
If you just look at I hate to do this because I don't want that ecosystem, but I mean, just the difference in conversations that take place in a place like Silicon Valley is just, you don't talk about your cabin trip. You talk about the deals that you're looking at and the startups that you're interested in, and that's just not our vernacular. So Silicon Valley aside, I think the thing that we should probably more focus on building community towards, or something like Austin or something like Boulder, that are out of the coast, have active communities, have changed their cultures to be pro startup, and engaged in the startup community, and therefore like continue to build companies and have the exits that recycle those investments back into those communities. So I've looked at a few different models. The Boulder Investment Group's an interesting one, and a model that's also similar to Groove's model is the Irish Angels, and I think their venture group's called Vitality or something like that. I'm blanking on it right now, but what I've come up with is not new. It's just new for Minnesota, and so I'm hoping that it's familiar enough, but also differentiated to solve a problem in a new way.
So I kind of went through the fund math where people started a new small fund, and then you have to be drawn into bigger funds so that VCs can make more money. You don't have to, but that's the natural incentives. What is different for Groove, and why is the plan for you to not fall into that same cycle of just raise a bigger and bigger fund, and therefore you have to write bigger and bigger checks?
Yeah, well, I'm hopeful that I'll have the opportunity to do multiple. Got to do the first one well first.
Right.
But the problem that Groove is going to solve is, it's a problem that really only takes a certain amount of capital, right? So it's not that everybody gets a check, or everyone should get a check at this stage. We are producing currently a volume of investable startups that until a dramatic shift in the culture changes where more people are doing it, it doesn't take that much capital to solve this problem. So part of the limited scope of this fund is bringing supply into demand into equilibrium. So that's part one. But the other way that I avoid shifting into raising larger funds and moving into later stages by combining it with an angel group. I basically have two business models and two ways to come at a problem that enable me to build a team and a practice around this pre-seed stage in a way that I don't have to leave, right? So fund mechanics on a small fund, like business model mechanics, are bad. And anybody that is interested in venture, do some research, because it's hard. And the math is not great, especially in the near term. Hopefully you're successful and you get paid in carry as these companies grow, but it's hard starting off. And so that's, I think, a big part of the motivation of why people raise larger funds and move to later stage. And so I'm not going to do that, because I want to stay as a consistent resource at this stage, but also by combining it with two different models, I'm able to do that. And so as the angel group grows, the operating revenue makes it possible for me to build a team that can be consistent resources for that stage.
Yeah, and so that's where you mentioned Irish Angels, not a geographic focus, I don't think, but that's like a Notre Dame alumni group that I don't think it's exclusive, but they like to fund other Notre Dame alumni. So it is a more focused group. They now have the fund and that sort of dual business model. And you can't, the reason VCs raise bigger funds is not just to pay themselves, but to have a team so that they can do more and bigger deals and ultimately create wealth, not just for the founders they back, but for themselves, which that's how capitalism works. So by having, it is pretty common knowledge among the VC community that you can't make a real good living on one fund that's small, but you can have a nice living on a fund that's small with an angel group along the side, and then multiple funds and the angel group growing, it can be a very large business without falling into that same trap of getting pulled up into later stage deals. So what's been I should have probably disclosed earlier in this conversation, I, Kevin McCardle, am an investor in Groove, although I don't think you can actually take money yet, because this is pretty early, but I'm in, probably like investor number 2 behind yourself, Reed. So I've bought into the idea, and actually I kind of referenced, like, I was thinking about how could somebody solve this problem before you kind of raised your hand and said you were going to try to solve it. What has been the reaction to others in the community that you've talked to, that are in your network, or other people in the investment landscape? Like, what's the feedback been? You just officially launched, within the last week as of recording, mid-August, but you've been working on this for a while and talking to people. Like, do other people agree that this is an issue?
Yeah, for me, it starts with the entrepreneurs, and trying to really truly understand the experiences they've had, and there are ways that they're getting around it, and that's like the amazing thing about founders is whatever obstacle it happens to be, like, they work their way around it. And so for our community, founders at this stage, if they have personal capital or access to high net individuals, which again is incredibly limiting, and keeps a lot of people out. But if they have that, that's one way that they can sustain themselves at this time period. The other is maybe they have a spouse or somebody who's gainfully employed at one of the many large corporations. They access capital from out of state frequently, or they bootstrap. And all of those things will continue to happen. And from a bootstrapping perspective, like, there's a period of time that is good for people to do that because it builds muscle. And so the companies that do survive the stage currently are building their companies in a way that's sustainable. And that's what's amazing about this community, is like, there's not a lot of fluff. It's the people that do survive it are building meaningful things and getting paid to do it. And so I want to find those people that have gotten to the point where they're showing that they've figured something out, and then help them to accelerate things. But so that's the founder side of things. On the investor side of things, to answer your question, Kevin, there's certainly an interest in this, and I think everybody has seen enough of the community growing to know that a fund focused on Minnesota can be successful. So I don't think we need to, like, try to create a case for that anymore, thankfully. I mean, Jamf as an example, with the incredible growth that they've demonstrated in Sport Engine and Byte Squad and all of the other kind of big exits and milestones that we've had are helping people be aware that great companies are being built here. But the thing that people are most excited about in the fund is the impact that it can create on the community. And so you check the box on the return, but then it's like, well, I can put my money in anything. Like, what's interesting about this? And when you start telling the story about the founders that we have in this community, particularly those that are female or founders of color, and some of the experiences they've had, and you give them a model that's alternative and has the ability to support underestimated founders in a way that nobody's done before, people get super excited about that, because they know that the system has to change. And so that's been well received, and I think the appetite for, like, we need to do better, and we need to do it now, is resonating, as we've been introducing people to this model.
Yeah, that's a big deal for me. And just the like if I could invest my dollars into something, well, I want you to talk about sort of what I think of as like the index fund. I like think I'm investing in the index fund of startups, the next 100 startups coming out of Minnesota. Because there's possibly a challenge with the angel tax credit data that you found, is if somebody makes one investment and it doesn't go well, they're way less likely to ever make another one, right? So I think there's somebody has a little bit of extra money, they want to help out either a friend or an acquaintance, but that's risky, and if that risk doesn't pay off, then that's a problem. So it is a much, just like investing in stocks, it's way more, it's proven to be a more successful strategy to invest in like the index than to try to sniper pick, one or two stocks that are going to pay off. So I want you to talk about that, but to finish the thought on like, if I can invest in anything, why wouldn't I want to invest in my own community and help to create jobs, help to create more wealth, help to back the founders that, I may see at the grocery store or, at the park, and lift up that same community. So you're absolutely right. You have to prove that there's a financial case to be made, but the data show that's there. And your experience with Beta shows that you specifically, not to discount the rest of the Beta team or the board, but you can pick good companies that can grow into be great companies. So once you check that box, then okay, well now this I see as a method to not only hopefully have a good financial return, but have a good social and economic impact in this community.
Yeah, it's different, and I think that's one of the primary benefits on the angel side of things specifically is in the broad portfolio of individuals' investments, like how many of those things do you actually like touch and see and feel? Probably none of them. And so this is a different asset in that you can talk to them and you can be a part of their journey, and you can have relationships, and that's different. So that's certainly appeal to the angel side of things, but on the index side of things, it's an interesting, like we already have learned that like if you're trying to snipe investments in the stock market, there's not a lot of people that can do that with any regularity. And so why would that not be the case in investing in startups? Like, especially on the early stage. So all of the research that I'm looking at is suggesting that the best way to minimize risk is to spread it out, because you're more likely with a lot of investments to hit the one investment that's going to go 50 to 100x. And so that the first thing that I needed to do when looking at this thesis was like, can a Minnesota index be successful? And from the data that of the companies that work with Beta, it shows that that is possible. And so having that experience and again that kind of muscle to that has been built over the last 7 years within Beta to identify companies looking at information that's different, because at the pre-seed stage there just isn't the same data. You're having to look at the qualities of the team, the idea, the market, and so the information that you have to work with is different. And so I think that's my differentiation is I've seen so many of those, you start to see patterns. And I really want to leverage that into a new way and apply that from an investment perspective. And I think that I've got, the list of criteria that are a lot of qualities that a lot of other people aren't looking at. I guess I'll leave it at that.
Can you talk a little bit more about that? Like what kind of companies are going to be a good fit? Is it industry agnostic? What will you be looking for?
Yeah, industry, basically just look at the strengths that we have in Minnesota. Like what companies are we producing that are successful? because we do have resources and networks that can support things like food and ag and retail and healthcare and energy and financial services, like wherever our corporate strengths are. Those are the types of companies that we need to be building from the ground up, because there's people and expertise to surround them to be successful. So those are the types of companies that I'm going to be interested in. Like if you come with a social network, you're in the wrong place to do that. You're not going to be successful here. And so I wouldn't discourage you from those types of things, but just be mindful of the resources that you have available to yourself. And then, on the qualities side of things, like I see this in every beta cohort, but let's say there's 12 companies that come into each cohort. There's probably 1 to 2 that almost immediately you can say these are going to be standout companies. And it's hard to articulate that here and like what that is, but it's obvious in each one. There's also probably, let's say 2, 3, 4 companies that that just aren't going to work out. And I would say the common thread in that is they joined a startup because startups are sexy and they thought it was going to be fun. And it turns out startups are a lot of work. And so I want to make sure that, as I'm selecting companies, you're weeding out the people that are in it for the wrong reasons. So they've gotten far enough where they recognize, oh shit, this is really hard. But I still want to do it. That's like box number 1 for the types of things that we'd be looking for in our investments. The ones in the middle of each cohort are the ones that it just takes time to figure out, right? So then you're looking at a lot of other criteria about financial literacy or their experience in the space, the story, their ability to tell their story. Like it's kind of touchy-feely in a lot of ways. And then there are some just pure mechanics about like what's your runway and how long can you last? How long are you willing to last? And so those are the qualities that'll come into play as we're making our own decisions.
I'm curious at some of the, like a segment we've referenced and that you're well connected to is some of the other VCs in town. Mary Grove, the Webbers, Brochard. What's been their specific reaction to this in terms of like, well, I'll leave it at that.
Yeah, I mean, in each one of those cases, those people have been partners through the beta journey. And so I'm a familiar face, and I think they entrust me to do work at this stage. So there's a lot of positive support and reinforcement. Like you're the right person because you've been in this space for so long. So that's part 1. Part 2 is, I think we all see the need to be building better pipelines. And so I think the energy around how do we capture information and start building channels into these funds, I think that's what's exciting for everyone. And, not just Groove, but for these other groups is like, if I can start working with the founder at this stage and start building them to be thinking about how to achieve the next milestone, that makes all those seed funds jobs more easy, right? Because I have the data, I can help the entrepreneur like position themselves to be successful in that, and if anything, just move them through the process faster. So getting a lot of positive feedback, and I look forward to being a part of a journey, knowing that there's a lot of links in the chain.
And it's more complementary to those other groups that people will recognize, not competitive.
Yeah.
Necessarily. Yeah.
Yeah.
And I bring that up because listeners to the podcast that aren't as in the weeds and the details of this, segment of the ecosystem as you are, may not differentiate that. It's like, oh, do we really need another fund in town? Well, yeah, we kind of do, because it's addressing a different issue.
Yep.
So you've done the research and now you've officially launched. There's no turning back. What are your next steps and how do people stay tuned?
Yeah. So the website's groovecap.com. That's where you can find me on Twitter at the same handle, groovecap. So follow along. The remainder of the year is really just pulling together the systems and processes to hit the ground running in 2021. So we won't be making investments until that time. So if you're an entrepreneur and you're listening to this and you want to reach out, wait until probably Q4 before we're going to start gathering information. Hang tight. I know that's hard to hear, but there's a lot of other places for you to go in the meantime. Reach out to the accelerators, start refining your concept, and start getting your company into a position where it's a no-brainer to make an investment. You've got, what is it, 5 months to do so. And yeah, I guess as the plan continues to roll out, I'm going to continue to provide education. So keep an eye out for opportunities to join me to have conversations around angel investing, and if you're curious about those topics, keep an eye on those channels to be invited to conversations about that. And then once we hit the ground running, it's just do what you can to support the companies that we're supporting, however that might look.
Yeah, so you got the founder side of the equation, right? Like it makes sense why you'd say hang tight for a little bit and call me Q4. People hearing this that may be nodding their heads about this. Okay, invest in my own community. There's a financial return. This index fund thing seems to make sense. I see on the website there's an invest with Groove button. And you didn't explicitly say it, but you and I have talked off the pod that part of the mission is to bring, you implied it certainly, but part of the mission is to bring new investors to the table. So people that have never made an angel investment, maybe don't even know that this is an option for them. But that is part of the goal, is to bring new investors to the table, correct?
Yeah, I'd like our, I don't think you can make investments in a diverse group of founders without a diverse group of investors. And so I want to make sure that the fund is intentional about that, whether that's the angel group or the fund. And so it's going to take a lot of work, and I'm doing that work now. The outcome we won't have for a while, but just know that there's some intentionality around there. And if you have feedback or any suggestions on how to go about doing that, I would encourage you to reach out. I'd love to. I'm an open book, and I want to be building this in public. So taking that approach, if there are people out there that want to share what they've learned, I'm all ears.
Awesome.
We usually end with a couple of questions that you're familiar with because you've been on the podcast, but given that you've already answered them, we've talked a lot about the nature of like, what do you love about Minnesota and who's doing great things in tech. I want to skip that. You've just launched a company. What's scary about that? What was the scariest thing about actually pressing go on this idea?
It's public, and this is a lot of chips accumulated that I'm putting back on the table. And so
you're not talking about money, I don't think, right now.
No, just personal capital and credibility and experience that I believe lends well to this next stage. I'm confident that it can be successful, but just knowing what's being put back in play is scary. And I think every entrepreneur has some fear of failing. And like, I've done this a few times, and like, it never fully goes away. But each time it is a little bit less of a concern. And so, I'm starting this in a totally different place than the last few times that I've been involved in this stuff. And so I'm feeling good. I'm feeling confident. This seems like the right model at the right time. But if it helps me be more, human, it's also scary, and I don't think that ever goes away.
I have bad news for you. It doesn't. I started my entrepreneurial journey 5 years ago, and it's still scary, even though
Yeah.
the business is fine, the business is healthy. It's irrational, but yeah, I think that's just part of what we sign up for as entrepreneurs. That there's always the little fear or the little devil on your shoulder saying it's all going to fail at some point. But
yeah, the other side of it, just to extend that thought, Kevin, is like, for me, this was an issue that, like, I just kept seeing it, and I just kept seeing it, and it never went away. And I feel like when you're the person that identifies the issue, you're the one that's responsible for fixing it. And so that's what I would encourage people who don't know how to get started into a startup or to create something from scratch. Like, what's the thing that you see that nobody else is seem to like get so frustrated about? That's a good indication that you may be called to fix this issue. And I feel that way about Groove and this problem that I'm trying to solve is there are not a lot of people that are in a better position to try to fix this issue. And so I don't feel like I have a choice, but I have to do it.
nice.
That's awesome. I think a lot of people, they want to become entrepreneurs, but they don't know what they want to do. And I think that's great advice to start with.
Yeah. You have to be passionate about it, because it's hard, and the passion is going to be the only thing that keeps you going at some point. So if there is no passion, it's not going to work.
Agreed. And I absolutely think you are the right person to solve this problem, given your background and your passion. And I've gotten to get to know you over the last few years. So I'm super excited for the launch. I know it's been getting a lot of attention. When you mentioned Twitter, I went and followed GrooveCap at GrooveCap for those that missed it. And in fact, a lot of those VCs that I mentioned, they're high-fiving you publicly and saying, yes, you're absolutely the right guy to go do this. So yeah, we will be following the journey and using the tech.mn platform, like with most entrepreneurs that we get access to, help provide a megaphone and follow your journey and help tell the story. So
I
super
appreciate all you
excited
guys
for
doing.
you. Yeah. And so Startup Week's coming. Any specific things to highlight as far as presence or activity, or is it more like stay tuned to the Twitters and you'll get the deets?
Yeah, I don't know if it's on the schedule yet, but Beta will be doing another version of its backers event, which is the connection point between investors and startups. And so as soon as that goes out, if it's not already public, if you're looking to have access to capital, that's an efficient way to do it. So keep an eye out for that. Or tell your friends, get them involved, and make sure that, if you're looking to have an introduction to an existing group that's actively making investments, that's the place to do it.
Cool. All right. Congratulations again on launch, Reed. Those listening or watching, I just realized again, we're live on YouTube, which is still weird for me, but go to groovecap.com, sign up for the email list, follow GrooveCap on Twitter, and get involved. This is good for the world. So I'm happy you're doing it.
Thanks. I appreciate your support. Thanks, Jack.
Thank you.